What is dividend policy? Dividend policy represents a company's strategic decision on how much profit to distribute to shareholders versus how much to retain for future operations and growth. So, this critical financial decision directly impacts shareholders' wealth and satisfaction, stock price valuation, company's growth trajectory, market perception, and investor confidence.
So, the key objectives of dividend policy. First one is regular returns. The main goal is to provide shareholders with consistent income in the form of dividends. This will help them, especially those investors who are dependent on dividends as a steady cash flow. Second one is strategic balance. Companies must balance between giving dividends today and retaining enough earnings to finance future expansions. Third one is investor confidence. A clear and reliable dividend policy will build trust with shareholders. That's when investors see transparency and stability, they are more likely to stay invested in the company. The last one is long term stability. A good policy will ensure that dividend payments are sustainable for many years without harming the company's financial health or operations.
So the next one is factors influencing dividend decision. So the first one is profitability and liquidity. So a company can only pay dividends if it has sufficient profits, but at the same time, it also needs enough cash flow to actually distribute those profits without affecting its operations. So second one is growth opportunities. Companies with good expansion prospect usually retain more earnings and reinvest in projects and capture new markets. That's why fast-growing rich companies pay little or no dividends. Third is legal and regulatory. Government regulations, debt covenants, and corporate laws may impose restrictions on dividend distribution amounts and timing. So the last one is market dynamics. Competitive strategies, industry benchmarks, dividend policies, and also shareholder expectations shape dividend policy.
Next is type of dividend policies. First one is stable dividend policy. Under this policy, companies will have to pay a fixed dividend every year, regardless of the profits fluctuations. It will provide investor with a security, and but it will put the pressure on the company during when they're earning low profits. Second one is constant payout ratio. So here the company pays a fixed percentage of annual earnings as dividends. This means dividends vary with profits. When higher profits are earned, it's good, and lower when profits will fall. Third one is residual policy. Dividends are paid only after meeting all the investments and growth requirements of the company. It will ensure the company grows strongly, but dividends may be irregular or lower in some years. Fourth one is irregular dividend policy. In this case, there is no fixed rule. Dividends depend entirely on available cash and management's decision. And it will give a flexibility to the company, but it will create an uncertainty for the investors.
So the next one is theoretical frameworks. First one is Walter's models. Walter's model. Dividend relevance depends on whether company's return on investment exceeds its cost of capital. Gordon's growth model. Bird in hand theory argues investors prefer certain current dividends over uncertain future capital gains. Modigliani-Miller hypothesis. In perfect capital markets, dividend policy is irrelevant to firm valuation and shareholder wealth. Strategic advantages. Steady income stream. Provide reliable, predictable income for shareholders who rely on dividend payments for living expenses or reinvestment opportunities. Price stabilization. Consistent dividend policies help reduce stock price volatility and attract long-term income-focused institutional investors. Enhance confidence. Regular dividend payments signal financial strength and management commitment, boosting investor trust and market credibility. Corporate reputation. Strong dividend track records enhance company image and facilitate easier access to company capital markets for future financing needs.
So the following are the potential limitations. The first one is growth constraint. High dividend payments may reduce available funds for strategic investments, research and development, or expansion opportunities that could generate higher long-term returns. The second one is liquidity pressure. Excessive dividend commitments can create cash flow strain during economic downturns or unexpected business challenges, potentially compromising operational flexibility. And the last one is expectation trap. Once established, dividend patterns create investor expectations that become difficult to modify without negative market reactions, limiting management's strategic options.
So next we can look into the real world application. So if we take the Indian IT giants like Infosys and TCS, they are famous for maintaining consistent dividend policies. This attracts income-seeking investors and builds strong shareholder trust and loyalty. On the other hand, startup companies usually take a very different approach. Since they need fund for rapid expansion and capturing new markets, they prefer to retain most of their earnings. That's why many startups pay little or no dividends in their early years. So we can look at an example is where a company earns rupees 100 crore profit, but the shareholders demand 70% of it as dividends, but the management wants to retain the money for growth projects.
And by this, we are almost to the end of our presentation. And now let us go through the key takeaways. The first one is the dividend policy is a strategic decision. Yes, dividend policy is a strategic decision because it is the policy that decides what percentage of the profit should be kept within the company and what should be given to the shareholders. This is important because this decision will decide the future prospects of the company and the long-term benefits of the company. And at the same time, it will also decide the happiness and the reaction of the investors to the company. And next is the context dependent. Yes, dividend policy decision is context dependent. We can say this because there is no one policy which is best for a company. The policies dividend policies varies from companies to company, and one decision which will be better for one company may not be the better for another company. And this is because the policy depends on various factors and characteristics of the company, such as the percentage of profit earned by the company, the types of shareholders of the company, such as, for example, if a company has old age shareholders, they might be demanding dividends on a regular basis in order to have a proper salary income in order to meet their day-to-day needs. But at the same time, if the company has young shareholders, they will be focusing on the future benefits and the long-term growth. And the third point is the balanced approach. Yes, dividend policy should be a balanced approach. There should be a proper balance between the happiness of the shareholders and at the same time, the future growth prospects and the long-term benefits of the company. So that's all about our presentation. Thank you.